Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. It's the first day of May, it's 30 degrees somehow, and we have another show full of the latest market goings-on for you today. We kick things off with Associated British Foods, which put out some pretty poor half-year results on Tuesday, as it deals with problems in its sugar business, with Primark and elsewhere too. Mike Fahy, Alex Newman and Julian Hofmann will ask whether the company is well placed to recover from its latest setback. Then we turn to our big read of the week, all about gold. The price of the yellow metal has soared even further this year as investors lose confidence in everything pretty much. Alex Hamer will discuss what might happen next, whether gold miners can pick up the slack, and we might touch on some of his shoe leather reporting in London's St James's Street too. Later on in the show, we'll look at the world of listed law firms in the shape of Keystone Law, which reported full-year figures this morning. Its consultancy-type model is still performing pretty well during a tougher time for the sector. Jemma Slingo will take a look. ABF to begin, though. Mike, you covered the results for us, so we'll start with you. A few problems there, chiefly in the sugar business, but not solely in the sugar business.
No, not solely. But the adjusted pre-tax profit was down by about 12%. The reported figure was much bigger, and the reason for that was the sugar business. They impaired most of the carrying value, about 100 million, off a plant they have in Spain. And the reason for that is that European sugar prices have fallen quite steeply. And when times were good and this plant was making a profit, I think it was allowed to happily run along as it was. But then as prices have fallen away, they said in the commentary that they realised that costs had maybe got a little bit ahead of where they wanted to be, that they were too high. And George Weston, chief executive, on the analyst call, went into a little bit more detail. I think he was asked, or analysts maybe suggested that it had been asleep at the wheel, and he argued that that wasn't the case, and that what has happened is that peers in Europe have just got a lot more cost competitive. They've built bigger, cheaper plants to operate, whereas it is left with a smaller plant, which is maybe now a little bit less efficient.
I mean, it does raise some questions, doesn't it, when you have this reassessment at this stage of the game where they think, actually, we've got some much bigger problems than we did have, but they have nonetheless recognized that, so that is something at least. We'll come back to that maybe in a minute, but let's talk about some of the other issues. The bioethanol fuels business, which is part of the sugar business too, also had some problems.
Yeah, again, he was very upbeat on this too. They have a factory in Hull which makes bioethanol from kind of animal grade wheat. He says that this should be incredibly profitable. It's a very efficient plant in terms of its costs. In Europe, the market is in kind of structural deficit. There aren't enough people producing ethanol. The issue is with credit, with particularly rebates people get from using waste products in ethanol. And it seems that both in Europe and the US, governments have been very generous in accepting what accounts for waste in terms of the inputs. So that's driven down the price of ethanol to levels where he says even this very efficient plant, isn't able to make enough money.
So that's being reviewed now as well.
Yeah, and they are attempting to lobby the UK government over this as well.
Which we'll see how successful that is. We're skipping around a bit. There are a lot of arms to the business.
Yep.
The bakeries, Allied Bakeries arm is another issue at the moment too.
Yeah. I mean, this is a very old part of the business. It was owned by the Weston family back in the 1940s, etc. But part of that is declining demand for bread, really, especially here in the UK where they make a lot of the money. So the Allied Bakeries arm, it owns brands like Kingsmill and Sunblessed, which, I mean, even the mere mention of that, it was a brand that was ubiquitous when I was younger. You'd barely see it anymore. And I think this business also lost a contract, quite a sizable contract last year as well. So it's been in a bit of decline, and they are looking at its costs as well, and they've placed it under review. They said there'll be more news on that in the second half of the year.
Are people eating less bread? Are they eating less sliced bread in
I think
favour of other
less, yeah,
things? Yeah,
less white sliced bread,
yeah.
which I suppose is where a lot of the demand, both for Kingsmill and
Mm.
Sunblest, comes.
Yeah, makes sense. Julian, let's bring you in to talk about Primark, which isn't exactly firing on all cylinders either. And as it's quite a big share of the business, that's arguably more important than any of the issues we've just spoken about. What did you make of the latest figures? Like for like sales momentum still not particularly good.
No, it fell by 6%, which for that business is quite a big fall. I mean, to be fair, they do have a very challenging backdrop at the moment. I mean, obviously, shoppers are incredibly cautious with their hard-earned money, and there are still lots of cost of living pressures around. But it does seem very worrying that Primark is on the end of that, because it's usually, if there is a clothing business that tends to ride through the cycle quite well, it's always been Primark. And sort of been up there with Next over the last 25 years for the amount of margin progression it can push through it. So to see it in a like-for-like sales fall, but more worryingly, the share of the market is also falling as well. That feels quite a generational shift. So I mean, I'm not quite sure what they can do to turn that around. I mean, it might just be a seasonal blip. People might decide that they still need their cheap T-shirts for the summer if we have good weather. So they could see an improvement in the next quarter, which might make up for this. But it is very worrying, I think, for investors to see that part of the business suffering at the same time as everything else seems to be under review as well. So I don't know what they can do about it. They're traditionally, they're already quite an efficient retailer when it comes to pricing in their clothing business, and it's hard to see where they can see any further costs out of it, particularly as as we all know, global trade is suffering under the current circumstances. And yes, I wonder whether that will have to be reorganized as well, as it seems like the rest of the business is already going through strategic restructuring. So yes, I mean, it's a case of wait and see, I think.
Well, they held the line on margins quite well, considering that like for like sales fall. Nonetheless, there's clearly only so much you can do on that front if sales do continue to fall. I mean, part of the problem does seem to be, doesn't it, that they have been competed out. They were once the lowest cost, and now the likes of Shein and Temu, these Chinese companies, are out-competing them on that front, really, albeit there may be some more positive news there, which we'll come to in a minute.
Well, we obviously don't shop at the same places, Dan.
Well,
yes, I mean, yes, it was always as you say, the discounter of choice, and where they go when they're not the discounter of choice is now the question.
There's also the issue of their planned US expansion, which could be tricky given this world of increased tariffs. And given the fact that a fairly sizable proportion of their manufacturing is in China, so you can see the US-China direct sales route is not as advisable as it once was, we should say. Alex, I'm going to turn to you, maybe for sort of a top-down picture or an overall look at the investment case for the company. We've outlined a lot of issues they have to deal with at the moment. It's not a basket case, though, it's fair to say, though. What's your take on the company as a whole?
I mean, one thing we haven't mentioned is the outlook, which they said, based on their current understanding of the tariff impacts in the second half of the year, that could be absorbed. So for a very international business, that's encouraging. Obviously, a lot is going to change between now and the end of the year. So so there is obviously a degree of uncertainty with that forecast. There are a few reasons, maybe for a bit of optimism, notwithstanding the sort of the disappointing interim results, like both on a reported basis and kind of as the market took it. I suppose one of the attractions of ABF has often been its sort of oddness. This conglomerate structure that you've got different well-run moving parts, but which aren't particularly correlated. So consumer retail sentiment doesn't really map necessarily to the sugar business, or they've got other arms, agriculture, etc. So that is potentially a strength in that while some arms aren't doing so well, and I think the chief executive said he was pretty pleased with 4 out of 5 of the divisions, that they can, that there can be sort of balances when, for example, the Spanish sugar business, as Mike outlined, is suffering. And one of the interesting things about this company is that they are the second largest holding, or at least were at the end of March, in Sean Pesh's Ramel Global Equity Fund, which has been one of the standout performers in the last couple of years in that sector. And that kind of implies that for that fund, ABF is the second best idea in a global universe of value stocks. One of the reasons they really like ABF is just the quality of management and how they don't ever overpay for acquisitions. But also, I think if you're worried about the outlook for this year, being in a business like this, which quite a lot of defensive, downside, both in terms of the nature of the business, as I was sort of mentioning, but valuation never really gets carried away. I mean, Sean Pesh, I think, bought when UK sentiment was at its really, really low ebb a couple of years ago. It's obviously sort of rallied a bit since and then come back off. But I mean, the business still, the book values even after this write down is something like £11 billion, and is trading at, the market cap is about 14 to 15 billion. So it might have a bit of an off year in terms of its free cash flow and profits, but it is in businesses that aren't going to disappear, white bread demand notwithstanding. I think it's really sort of proved its mettle over the last 5 years, even though the share price doesn't always look that way. So I think it's a very, very good business, even though the volatility in the bottom line is probably going to be a bit more pronounced than you would expect of a quote unquote quality business.
Yeah, that makes sense. I mean, there are some short-term potential tailwinds as well. They did say things were picking up a bit in the UK. It's quite keyed in, certainly Primark, to UK consumer spending and retail sales, things like that. And there have been some positive signs there. To get very macro for a second, if we do see more dollar weakness, that's quite good for them on a cost of goods sold basis. A company that can take advantage of that. There's questions over the US rollout, as I said, but that's not really a core part of the Primark business yet. So that's one for the future. And Mike, just to bring you back in, to go back to the competition, there's potentially some positives that could come out of that in terms of the greater restrictions that might be placed on some of its Chinese peers.
Yeah, well, even looking at Primark in the US, they did say that tariffs would create some unmitigated costs in the second half. But I think they're generally quite sanguine about the level of those costs compared to the overall level of the company, its operations. And, it has much bigger costs in terms of retail and staff, rents, etc. And putting products in front of consumers like that compared to an online model like Shein or Temu, where they can ship parcels directly from China by air freight and not really, and charge lower prices because A, they don't have those overheads, and B, they weren't paying any customs duty on them because of this de minimis rules, as they were talking about, this kind of exemption for parcels under $800. That is being removed, and that is being seen as quite a big blow to Shein and to Temu, its rival. So any parcel coming in now with a value of $800 or less immediately attracts a $25 charge. And if the items you're shipping in, you're charging people $20 to $30 for them, then that's going to be something that they're going to have to grips with. And the feeling is that the way that Shein and Temu deal with this and get to grips with it is to build more infrastructure in the US, which then clearly adds to their cost and makes a Primark more competitive. And the same sort of rules are also the European Union is looking to introduce, and the UK government last week said the same thing as well.
Yeah, indeed. Just to wrap up on the valuation, you've perhaps split the difference between Alex and Julian's views at the moment.
Yeah, I figured 12 times earnings is probably about fair enough. It was on a hold previously, and I looked to think, was there anything that massively influences a change there, and there isn't. There is clearly the potential for a recovery if there's signs that things get better, either in the Primark business or in sugar, where they talk about a well-defined plan to overcome things. But there are also risks. There are risks that we've talked about with tariffs. There are risks that the sugar business continues to be a drag, and even the grocery business didn't do that well in the first half. So I figured from the risk-reward point of view, where it is at the minute is probably fairly valued.
Yeah. Well, as ever, we will keep an eye on the latest developments, and it's been an interesting company to discuss, so I'm sure it's one we'll return to on the show as well. For now, though, we're turning to our big read of the week, which is all about gold, bullion, the yellow metal, which has had a fantastic year. It is down about 4% this week due to generally improved sentiment elsewhere, but nonetheless, over the past year, is still up about 30%, almost a third. Alex Hamer, you've been writing about this for us. Let's talk about, first of all, there's always a lot going on and some uncertainties as to what's driving the price, but maybe we can potentially split it into structural factors as well as some of these near-term factors too. So let's start with perhaps those structural catalysts or the structural shifts we might have seen arguably over the last few years, because this price rise has been going on for quite some time now.
Yeah, thanks, Dan. The way that gold has been traded and the reasons people buy it has shifted a little bit in recent years, and that's largely been due to China, which is not a great shock. Most industries have felt some kind of impact of Chinese investment, either through the middle class or government actions. In gold's case, it's been both, where the central bank has bought up lots of gold, and then also probably a bit more recently, investors have turned to gold there as the housing market and the local equities market have been weaker. What that has done, according to gold experts, is put a bit of a floor under the price. And to sketch out that chart a little bit for people, gold had traded under $2,000 for quite a while. The previous record was $1,900 in 2011, and then it had crept up and then was really supercharged last year, and then it broke the $2,000 mark and then quickly made it to 3,000, 3,500. So apologies for the run of numbers there, but it really has been a striking run. And then the focus at the moment is because of people landing on gold as a safe haven at a time when bonds aren't looking like they used to. That's government bonds particularly. And the focus had been US bonds as Donald Trump made his tariff moves. But from people I spoke to, there was also concern over bonds elsewhere. And this is where the gold bug, I guess, skepticism over government spending and government debt comes in, because they look at bonds in the UK and Europe, even Switzerland. I heard there was a bit of skepticism over the Swiss government's management of its own finances, which is the first time I've heard something like that, and probably won't again. But all those factors have gone into people buying into gold a bit more recently as well.
Yeah, in Swiss government bonds yields are almost negative again, aren't they? So people are paying for the privilege to lend them money. But yes, clearly there's been this rise in debt levels globally, and geopolitics also feeds into this, doesn't it? We've seen increases on the back of things like Russia, Ukraine, and clearly this year, as I said at the top, the general concern about the US status has fed into that in a variety of ways. What about the correlations as well? We touched on bonds maybe not acting as such a good safe haven. Gold typically it has correlations in theory with inflation goes up, gold goes up too. There's the US dollar in there. There's a lot of things, but some of these have been changing over the past few years, perhaps partly because of some of these structural shifts you've just spoken about.
Yeah, I fully agree. And that floor put in the price by central bank buying. So it's China, but it's also Turkey. Russia had been buying, although it gets a lot of its supply locally because of the pretty high volume gold industry there. But I think one thing to point out, you mentioned Russia, Ukraine. We've seen buying activity in far greater levels than we have this year in 2022. And I think even ETF holdings peaked in 2023, and there's been quite significant selling, particularly from North America and Europe since then. So that's part of the idea that we've seen gold go to $3,500 last month. Now it's about 3,300, and yet there hasn't been that volume of buying through ETFs. It's certainly gone up. Q1 it climbed a lot, both in Western markets and in China, but it still remains quite a bit lower than it was a few years ago. And I think that that point is important when you think about future price movement, but also when we're looking a little bit at future price movement, but then also in the way that the market has priced gold in terms of, we had reference points that with US dollar and interest rates, as you mentioned, but they've split about 2017, 2018. There's reverse correlations there. So when interest rates were higher, gold was weaker, because if you've got money, why not put it into something that's going to give you real yield? Gold obviously doesn't do that, but it should also protect your money from devaluation of currency. So that broke away a little bit, and then the dollar thing is interesting because we have kind of come back to it a little bit, where the dollar is weaker and people are buying, but frankly, a lot has happened in the past month, and it's a moment where there's a lot of levers moving, and we can't pull correlations from from much of it.
It's hard to deconstruct some of those drivers. Nonetheless, it has been quite good, as we have a nice chart in the piece, at being inversely correlated with shares. I mean, it's been going up alongside shares in recent times, but it also tends to still more or less do quite well when shares do badly. So maybe that brings us on to its role in a balanced portfolio, because some people have been wondering or considering gold as a, if not one-for-one replacement for bonds. For people who have a quite a cautious portfolio, they have been increasingly maybe looking to gold as doing some of that job. I know, Alex Newman, you wrote at the start of the year when we were looking at a 5-year outlook that some small gold holding would perhaps be advisable in a balanced portfolio nowadays. And that tends to be the sense that we get from speaking to external managers, things like that.
And you can even split it. This is the work of a Swiss fund who thinks that gold's going to be, I think, $10,000 by the end of the decade. But just leaning a little bit on their research, they encourage people to look at physical gold. So in your portfolio, that's something that either you could have it at home or pay for someone else to store it or use an ETF. But there are options you can get that are free of CGT, which is attractive given that threshold's lower. It's free of VAT. Obviously, shares are as well. But that's something to keep in mind. And then also the Swiss fund Incrementum, they talk about performance gold, which is gold miners. Obviously, if you drill down a little bit into it, a lot of the miners have had a fairly mixed performance over the long run. But I think the question that keeps occurring to me is, gold's at an almost record high and has been at a record so recently. Why should I buy it now? And I think that's a question where it is acting a bit more like a performance asset because of the extreme gains recently. If your view of the value of currency is if you're fairly skeptical on that, adding gold is certainly something for you right now. It is an oddly personal question in a way that an equity with a PE valuation or yield of X is not at the moment.
Yeah, I think in the IC Alpha portfolios, to take another example, I think gold is in there, but capped at about 5%, so it's still pretty small overall. Let's talk about gold miners, though, because, as you alluded to, they have lagged the gold price rise, perhaps unsurprisingly given the extent of that rise. But historically, their investment case was always, well, we might do worse on the downside when things are doing badly, but on the upside, we'll outperform. Clearly, that isn't happening nowadays either, but there are some arguments to suggest that some catch-up may now be due.
And I think we're speaking in general terms here. There are companies that have outperformed the gold price. Hochschild in London is one. There's been a happy, I guess, coincidence of it bringing on a new lower-cost mine and alongside a rapid increase in the gold price. So if you're listening, I haven't forgotten about you, Hochschild, and there are others, I'm sure. But if you plot it against various indices that capture gold miners, it's not as pretty a picture, and that has started to reverse that underperformance in recent weeks. And I think what's happened recently is that for some time the higher gold price was balanced out by higher costs, and those costs have leveled out. Growth in those costs has stopped, or even they've come down. So the profits are actually coming through now, and the fund managers I spoke to were pretty confident that the interims are going to be pretty impressive, and where that will come through is in dividends. A lot of companies will pay out a proportion of operating cash flow or excess cash. So the dividends are in line to increase. They're, it is quite vibes based, to be honest. I mean, people have been buying. The big winner out of all this is a Canadian company called Agnico Eagle. They have become the biggest gold miner by market value, outperforming Barrick and Newmont. And to me, that's not a surprise, because Barrick and Newmont have been pretty shocking performers for quite a long time, and just kind of sit at the top because of their historic base. But the rise of Agnico shows that a better portfolio that's lower cost will win out. So I think, the miners they have caught up a little bit. I think there is more catching up to do, especially when you've got London listed gold miners on EV/EBITDA ratios of 2-3 times. When the majors that have, the majors do have massive institutional interest and retail interest, where the mid cap and small caps might not have that, but they're trading 10 times on an EV/EBITDA ratio. Like there's got to be a bit of middle ground there, and I think there is more catching up to do.
Let's wrap up by talking about your trip to St James's Street in London, to a gold trader, a vault storage space. I mean, it did seem from the reporting that a lot of people in there were selling gold, but that's not necessarily an indicator of anything other than the fact that the price has been rising recently, and even in these fancier locations, you're going to get people looking to cash in. But what did you learn down there?
Yeah, well, I mean, I wouldn't say a lot of people were selling. I saw a few customers, and it was either people. There was a question on pivoting to silver, which, if you own physical, is basically a terrible idea, because you pay VAT on silver once you take it out of the shop floor, and you don't own gold. So that's an immediate immediate rise to come out even on that one. But I think it's quite fun to go and look around, to be honest. I mean, you're not walking into a shop and there's just stacks of gold bars worth tens of thousands of pounds or more, but they sell bar and coins, and that ranges from 10 grams to kilo for a lot of money. It's a very slick operation. I unfortunately didn't get budget from the IC to bring a few coins back with me. A Britannia, which is the 1 ounce coin that the Royal Mint produces, that is CGT free because it counts as currency. That one is pretty much sold out at the moment. So it was interesting talking about those demand dynamics as well, where people are really into those coins. And the silver option has also run out, the Royal Mint told me. So there is a bit of interest in silver as well, which is obviously much cheaper, VAT, CGT free if you're buying it as a currency. So you skip that as well. But yeah, just really interesting place to be. My assumption of being around St James was people would go for a long lunch at the Ritz or the Wolseley around the corner, come in, throw down a few, tens of thousands of pounds on gold, but they assured me that was not the way that they did business. And it's also, that's the shop front, but they're also taking calls and online orders all the time. So it's kind of, you see quite a calm operation, whereas they're kind of, it's a pretty hectic environment right now. Yeah, it was fun to be there.
Yeah, I mean, yeah, you're definitely, given the way the price has risen this year, you're definitely getting a few more people coming in and buying, well, I suppose, to put it very crudely, buying for reasons of greed rather than fear, which is perhaps the pullback this week is a lesson that's not always advisable, is it? But as I say, that is the big read this week. There's a lot more information in there in print and online. Do take a look at that. We're going to wrap up today, though, with Keystone Law. the AIM-listed law firm, which reported full-year figures to the end of January this morning, I believe. Jemma, you took a look at those. What did you make of them? You've covered the legal sector for us for a number of years now. It seems like they're still doing fairly well in a broadly more difficult time for the sector.
I think that's fair. I mean, Keystone's an interesting one in the legal sector generally because it's very different from traditional law firms, even those that have listed on the stock exchange. So while lots of law firms are typically structured as limited liability partnerships, Keystone's essentially a platform. Its lawyers are self-employed and essentially take a direct chunk of what they bill. And in return for what they give up, they get a host of things like a central office, IT infrastructure, trusted brand, and sort of access to a small pool of general sort of junior lawyers. So it's always an interesting one to follow to see how it's doing. But I think today's results looked pretty strong. So they reported double-digit revenue and profit growth. A key highlight for our listeners is probably the special dividend, which was announced today. So everyone seemed pretty cheery despite everything that's happening elsewhere in the market.
Yeah, can we say a bit more about some of that context? There have been some problems, certainly for, you think of other listed companies, the likes of RBG, which is suspended early this year. It's a smaller business, but at the same time as that, there's general hiring issues which other companies have which don't operate this model, which they've found things a bit more difficult on that basis.
Yeah, so the collapse of RBG was quite a specific case because there are other factors going on there. You know, there are management issues, a litigation funder thrown in, which thankfully Keystone does not have to deal with. But one of the key ways that Keystone grows is essentially by recruiting more and more lawyers because it entirely shuns inorganic growth. So it basically needs to keep dragging people in order to keep growing its revenue. And as we know, sort of in the wake of the pandemic, the recruitment market was extremely hot. And the legal sector in particular saw huge amounts of movement and sort of the salaries being offered were just insane. So it had a bit of a tough period trying to keep attracting those senior lawyers that it needs. And it wants sort of big names so it can build its own prestige and sort of get the best cases. But in the latest results, they were saying recruitment had essentially normalised. It was back to pre-pandemic levels. Churn seemed to have calmed down in the second half of the year as well. So on that side of things are positive. And the other obvious way they can grow their revenues is by squeezing more out of the existing lawyers. And that was also sort of working. So yeah, seemed a positive picture.
Yeah, the number of new starters, to put it in very mundane terms, is still growing at a decent rate, which, as you say, is obviously crucial for the business. Perhaps some of the issues elsewhere in the sector make them more attractive as well. You would imagine that kind of decentralized model is relatively attractive anyway. What about their working locations? Because they were fully remote, or this kind of model does lend itself to that. But they mention in these results that they have kind of reconsidered their office space and refurbed it a bit. What have they been saying about that, and what's that kind of split now?
So they have sort of a swanky office on Chancery Lane, which is obviously the heart of legal London, which is, you know, relatively expensive to upkeep. They've done a refurb so it suits all the staff. And I guess they want some posh premises if you're trying to entice lawyers that are used to sort of these beautiful glassy skyscrapers. But generally, it's still a much more decentralized model. So they're not having to house sort of thousands of lawyers all over the world. So I was having a look about where they're based. They've got the London office, which is the key one, and then they have sort of just meeting rooms scattered around the country. So they've got some in Bristol, Leeds, Manchester. But it does mean that overhead is significantly smaller than if you're a traditional city firm and you're just having to keep everyone on site in their sleep pods, sort of working all hours.
I did see their London office was graffitied recently by some protesters protesting their work with an Israeli company. So I wonder if that came before or after the refurb, but that's a question for another day, perhaps. Let's look at the valuation of the company, because they've typically been priced at a bit of a premium to the sector because of some of these qualities you've just spoken about. Is that still the case, and how do we sort of see the prospects for them in future?
It's always tricky with Keystone because I look at it and I think operationally it's looks really good and it's very cash generative, it's lean, like it should attract a good valuation really. But shares have never really recovered from 2022. So in 2022, the valuation was riding sky high. Sort of, it was a PE multiple of about 40, which really should have been flashing some alarm bells, I suppose. But since then, it has been waning, and it's currently trades on a forward PE of about 17. My sense is Keystone does operate in quite a nice defensive area at the moment. Like, legal fees tend to keep flowing whatever happens in the economy. So maybe it will start attracting a bit more investor interest. But obviously, it's growing exclusively organically, so there's never going to be sort of explosive growth. And it just seems the professional services market's never got investors that excited. So I was talking, it might have been last year or the year before, to a consultancy called Elixir, which some listeners might follow. And the chief executive of that was complaining that, they weren't getting a fair valuation. And that was another AIM traded company. So it just seems it's hard for these sort of very people-focused businesses to generate the buzz that some other sectors manage.
Yeah, it's not quite the well, there is a lot of intangible strength there, intangible assets in some ways,
Yeah.
but yeah, very people focused is still not
Yeah. And I
particularly
guess
fashionable.
the intangible assets can just sort of get up and leave and go to
Well,
Slaughter and May or
yeah.
Freshfields or one of the other big names. So that's always a risk overhanging the model, I suppose.
It's true. The intangible assets are in the brains of people who can jump ship very quickly. Well, thank you very much for that, Jemma. We have unfortunately reached the end of our time today. That brings us to the end of the show, but thank you to everyone for listening. Thank you also to Mike, to both Alexes, to Julian, and to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.